Today we're going to be talking about the first 2 hours of the 12 candle window. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. We've had some massive moves on gold on Monday, 700-800 pip moves. We've had some great trades on the British pound and the pound Australian yesterday, huge move. We've got some reasonably normal volatility since the Trump-Biden election has, I guess, sort of started to transition, but the markets have resumed their normal trading. And today we're going to talk specifically a bit more about the first 2 hours, the first 8 candles of the 12 candle window. We're going to answer some questions that have come up, and we're going to review the simple steps and just hash again on some importance of personal management and developing some strategies to help you not only focus on your strengths, to magnify your strengths while you're trading, but also to minimize triggers or potential danger zones that can show up and enter into the picture as well. So first off, just going to mention, I've followed mainly the British pound crosses, and specifically the last month or so I've narrowed that down pretty much to just watching the pound USD, pound Australian, just for preference. I was taking a lot of my trades on those pairs, and although the last few days the pound Canadian, pound Swiss have given some massive moves, but again, any instrument on any given day is going to offer those opportunities, and I'm always just looking for the best setup out of one of those pairs. But most recently, in the last 2 weeks specifically, I have only traded gold, and for whatever reason I just seem to be very specifically attached to trading gold at the moment, and so far I like what I'm seeing. But that said, it has its own challenges, a bit more volatility obviously, but again, today what we're going to talk about may clarify some things for all the pairs. Secondly, there's been people bring to my attention, there's somebody using my identity on Telegram and on WhatsApp, selling signals as well as personal instruction, using my pictures, using some of my name and everything else. Just to let everybody know, that is a scam. I do not have that set up on Telegram. I am not selling a course. I provide everything in detail, hopefully that helps you each and every day as traders develop your own trading skills to get better and better, and at the same time keep moving in a direction of constant progress. So one of the questions that did come up, and by the way, I've had a chat with this person and they seem to be reassuring me that they are indeed Stacey Burke. So anyways, adjusting your risk. So somebody's asked about gold, how to adjust the risk because the stops are bigger. Obviously some of the candles can be bigger. One of the things that you need to be aware of is that when you are setting your risk, understanding what your pip value is based on your currency that your account is set up on, and then obviously understanding how much you're using in terms of a stop loss, and then understanding that exchange of the pip value times that, and not just converting it at $10 a pip USD if you're trading in Aussie dollars, or if you're trading in pounds, whatever currency you're trading in. But you need to know to adjust the exchange of the currency in your account to the instrument so that you can understand the dollar value that you're placing at risk, if that makes sense. So again, your currency, so the currency that you're trading in times your currency in terms of the instrument. So if the instrument is gold, well then you'll need to know the pip value for each pip, per pip. And then obviously the distance or the amount that you're using for your stop loss. So it's not just a matter of saying 1 pip is equal to 1, because it may not be. I know that for Aussie dollars it's about $14.30 per pip, roughly. Next thing, understanding that anything is possible, and we saw that on Monday on gold, but even yesterday on pound Aussie, pound, we've seen some very dynamic big moves in the market, and Mark Douglas says this anything is possible. When you understand that, you also understand the importance of managing your downside. So in a lot of cases, this is paramount, because as many of us has probably found out on numerous occasions, that as much as markets can move in your favor, they can move against you as well. Now, I had a trader recently comment that he didn't like to use stop losses, and I think that that's an individual choice. I think that for myself, I always enter in the stop manually, because it always seems to be that even when I will exit the trade, if I was to exit the trade on my own, that I always get a worse fill, because I end up getting filled after the stop if I had placed it in there in my platform to take me out automatically. But one of the things to understand, as we saw in gold on Monday, the trader's comment was that the market always swings back, and that would allow him or her to get out of the market at break even or with a small loss or whatever that may be. The only unfortunate side is that if you are caught in a very strong market, I know in two instances. One, obviously on Monday, gold dropped 1,000 pips. If you didn't have a stop in place, it's still not coming back. You may have blown your account out. But I know another instance, a few years ago, a trader shorted the pound yen at the low of the year, and they held on to that, and eventually that loss grew over month after month to the point where it blew out over $100,000. And had they just taken that initial loss, the next day they would have been back in the market. So one of the things, talking about using stop losses, and one of the other questions that came up recently is, how do you handle getting over a big loss? And now that's a challenging thing sometimes to get past, and depending on how big that loss is and how it manifested, unlocks a lot of other issues. So for traders that, if you've gotten over if you've had a loss and it's maybe bigger than normal, or a loss that was unexpected, whatever that may be, then you need to just get back on the saddle and focus on process and doing everything specifically right, trading smaller, getting those runs on the board, getting that confidence back. If it's a big, massive loss, that can be very, very hard to bounce back from. And so again, depending on how big and the nature of that loss, that trader may need to take a break and do some work on just reviewing their objectives, their goals, their process, what triggers led to that loss occurring, what can be done in the future to prevent that happening, how can you tweak that process and refine it so that that doesn't happen again. So again, I'm critical to use stop losses. Obviously, there are different types of losses. There can be losses occurred because of excess leverage. There can be losses occurred because of lack of process. There could be losses occur because of breaking rules and averaging into losing trades, all those types of scenarios. So it's critical that traders review that entire scenario and then develop some strategies each and every day, similar to what I talk about in the 7-step daily routine for high performance traders. It's about creating some rituals that will help bulletproof you for success, reinforcing your strengths, building on your strengths, constant improvement and progress, developing a growth mindset, and growing your trading business. So one of the things we'll talk about today, personal management. Planning your trades, managing yourself during trading time, and execution of those trades. So coming back to the 12 candle window and the first 2 hours, the first 8 candles, specifically I talk about the equities hour a lot being really important. But the first 2 hours will often paint the high and the low for the session. By the time that second hour, that 8th candle is done, in most instances, the high and the low for that session will be in place, meaning that they've now established the boundaries. We'll call it high of session, low of session. They've now established the boundaries from which they will be trading from. And in some cases, this may be the high of the week or high of the day, or the low of the week and the low of the day. But what's important is that once that high and that low are in place, so again, that may be the first hour, this could be the second hour, Now we have our boundaries for the market to either work back into for our W formation or work back up into for our M formation. And again, obviously there's variations of that. We can get an extended W, an extended M. We can get a shortened W and a shortened M. Different ways that those can occur. But most importantly, understanding that the high and the low, once they're in place, and in some cases at the high or the low of the week, those highs and lows may be reversal points for trend trades or stop hunts back to the high for a 3-push pattern back and then a measured move down, and that's where we get our structure from. So these first 8 candles, if you go and look at your charts, your 15-minute charts, often we talk about that 1, 2, 3, or it could be a 1, 2, 3 down over the course of an hour. We will often see sometimes that bull hammer at the low, or the engulfment or bear hammer at the high. But that's where we'll often have our first extreme put in place. How do you know if it's a breakout versus a stop hunt? So this is where this 12 candle window comes into play, because often if we're at the high of the day or high of the week, low of the day, low of the week, this 1, 2, 3 may be an entry into the trade. But sometimes traders will take these and they'll come down 1, 2, 3, and then it comes back, and they either get stopped out at break even or they hold on to it and their stop is in place. But again, this is where the structure and the behavior of the price action at the high and the low are what's important, because we're looking for engulfments and pin hammers. So if we print off our charts, we'll often see pins on the highs of the day and lows of the day, or engulfments depending on where they've happened, and we may get a peak formation in Asia or London for a peak formation low or a peak formation high. We saw a textbook peak formation low last Monday on the British pound. These M and W formations may not be on the 15-minute chart all the time, so we may get a pin hammer or an engulfment, but we may have an M or W formation that's on a 5-minute or a 1-minute chart that gives us a 2-bar reversal engulfment at a high or a low. So these are some of the variations that, if you're not familiar with, you need to go back and review those. So some traders have asked, well, why don't we use the 5-minute charts or the 1-minute chart? Well, you can. For me, I think that it's easier to use the 15-minute to establish where the high and the low are from a big picture perspective, and then also the behavior of the price action at the round numbers, double zeros and 50s, at the timings. So again, coming back to personal management, planning, management, and execution, one of the reasons that I really specifically hone in on that first 2 hours, specifically that equities hour, is because once that equity hour has traded, if I haven't already gotten into the market, I know that by that 3rd hour, if there is a 3rd hour trade, I want to be in that market, in a trade, and in process, or I'm off the screen. And the reason is that once we get outside of that 12 candle window, as we've talked about before, in most instances, now there are trades obviously just prior to the US session at the highs and the lows on certain days, some great trades, but specifically in that gap time, and as we get further out, if they've already moved the market from high to low 50 pips or more, a lot of the price action that is generated afterwards is designed at potentially trapping traders inside or in poorly moving trades, or spiking them inside of a 25 pip box, or doing all kinds of things, just jamming them in and not really going anywhere, and then you're caught in the market, you're sitting there, you're nursing this trade, and meanwhile, as we head into the next window, then we see the market burst to one of the extremes, to either complete a move, to hit stops, to trigger breakout orders, stop loss orders, whatever that may be, before reversing or setting up the next 25 to 50 pip box for the next session. So again, that first 2 hours, that first 8 candles, you'll often have a high or a low established now, and then even if it's a 3rd hour trade, that's where we get that third hour working into the low or into the high for the reversal. Now, in some cases it may be a trend day. So there was a great question a few weeks ago on the pound Aussie. We saw a big move down, and then in the US session they gave a bull candle breakout in the equities hour, I believe. The market had gone sideways, it had come down. The trader went long, stopped down here, and the next bar immediately reversed and engulfed this big bull candle. This is inside of the US session 12 candle window, and that market continued down. Now that market did a measured move of that bull candle distance. That bull candle in this strong trend was merely a stop hunt against traders who got into the market on that lower level as the 12 candle window started. So there's a difference again. If that market was potentially going to be going back up, what we would have saw was possibly a pin, a pullback, and maybe hit it a second time, and again either with a pin or an engulfment for our W formation. But when the market is just coming down and does a stop hunt back up, that is often a trap taking traders into the wrong direction before they complete a measured move. So there's been some interesting questions about the measured move. Again, I just used the Fibonacci tool. I've erased all the numbers out of there and I just put 100% expansions. If you want to read more about that, get Schaubacher's book, Edwards and McGee, just geometrical expansions of those trapped areas of volume. But in most cases, they're 25 and 50 pip boxes, and I will often target a minimum of one full expansion of that range that the market has broken through. Regardless if it's a big bull candle in a down market or a bear candle in a bull market. So personal management, coming back to timings, I know for myself, I want to be really crisp and focused, specifically in that first 2 hours. I want to try and, if the opportunity is there, be in my trade by that second hour, and I like to be in profit or at break even or out of the market usually within an hour of me being in that move. If that market has, if I've timed it properly and it is a fast move or it's moving, it should be in process. But usually after an hour of being in the market, as we all know, when these markets go and they take off, they usually will move in successive candles. So 4 candles in an hour, if it's already taking off, I should be able to be at break even. In a lot of cases, these markets will have already hit their 50 pips or more, sometimes less if it's at the high of the day or the low of the day or at round numbers. Again, the market sometimes will go to a round number just below a high or just above a low and not go through those levels before coming back. And part of that is in the psychology of how they will keep traders in the market without letting them out taking profits and coming back to either shake them out of the trade and in some cases stop them out with a break-even trade before resuming that move, or even just rolling over and putting a lower peak in place or a lower peak in place at the low of the day. And again, traders are holding on for that extreme to be broken, only to be disappointed in getting stopped out at break even. So again, understanding, have a plan for yourself, not only for timings, how long you're at the screen, preparing, planning. I talk about median price. I go to the screen. People have asked, what are you thinking? What are you thinking? When I go to the screen each day, I want to know, where is my 50 pip box? Okay, I could be in a 100 pip box, but specifically I'm usually going to always be in a 50 pip box. The numbers, we'll use red. Okay, in most cases, especially just prior to one of the sessions, we will be around some number or traded up into some number. I call this median price. If that's my 50 pip box, and in some cases this could be a quarter level also, I'm going to wait for that market to go 25 and in some cases 50 pips before giving me a trade signal, usually back through the other direction or to the high or low of that session. Or we may see a continuation and then a reversal right into the open for a 50 pip, 25 to 50 pip move to the other side of median price before the market comes back and reverses, depending again if we're at the high of the day, the low of the day. Have they already done 3 pushes to the high? and I've talked about the 33 trade in that first hour is usually the only trade setup that I will have in that first hour, as opposed to the market making a high or a low in place and working it in that first hour, and then we're coming back in that equities hour either to the extreme, getting traders chasing that move into the extreme before reversing and engulfing and heading back in the other direction, but also understanding the difference between a market that's trending or breaking out and pulling back to continue that trend. So hopefully that makes sense. But for me, timing is very specific. That 2-hour window is critical. I know in the past, a lot of the mistakes occur the longer you're at the screen and the market starts to play its games with the algorithms, and unless it's already in process, anything that comes later typically doesn't work out that well for me, and I get into these trades that I get caught into. So I have a very strict rule about sticking to that timings, and ideally I'm done hopefully within that hour when my trade is initiated. But that 12 candle window is the high priority time for me. Once it's done, if I'm already had my trade or I'm in the trade, I'm at break even, whatever that may be, I'm going to stick to that, get off the screen, go do something else, come back for the next window. So hopefully you got some value from today's video, traders. Again, thank you for all the questions, emails, and comments. Thank you for hitting the like button. We're going to look at some charts from the last few days. Keep it simple. High of the day, low of the day. Are we up high? Are we down low? Is the market working into the low? Is the market working into the high? That first 8 candles, in most instances, will establish the high or the low for that session in that first 2 hours. So hopefully everybody's seeing improvements in their trading. Keep getting better, 1% better every single day, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, and just reviewing the pound, gold, pound Aussie from the last few days. We're looking at Friday on gold, Thursday as well. Again, just talking about the first 8 candles will often establish the high and the low for that session, and then the market will usually trade back into an extreme, or if it hasn't already established a move, will usually work into one side, into one of those levels for the reversal or the continuation trades. And we see on Thursday, gold just in Asia, again, 1, 2, 3 to the high, a bear candle, 1, 2 down to the low of the day. So we have our high and our low now potentially in place. The market works back up into the high with 3 pushes before working back down in the gap time, and then coming back up to the high, 1, 2, 3, consolidating, and a bullpen hammer at the open. So again, understanding that we're inside of the previous day's range. If price is always in a box, we're still inside of that box, but the market is working higher in Asia and then into our Europe, London 12 candle window. So traders see the engulfment during the day, they short that, but they're actually still inside of the previous day's range, and the market is breaking into the next 00 100 pip box, breakout pullback, bull candle, then a bullpen hammer for the continuation, and again you can see the consolidation at the high of the day. So if I'm focusing my window of trading on the 12 candle window, everything that happens in the gap time is still valuable information. So again, we could come into London thinking that this potentially may be a peak formation for the high of the day, except that we're still inside of a previous day's high and low. So in most situations, we still are inside of a box. The market is moving higher towards the top of that box before breaking out, moving sideways at the top of the box, and engulfing in the gap time, heading into the 12 candle window on a breakout. So now we potentially have what's referred to as a measured move. And again, if we go back and just put on, that was election day, we put 1 full expansion of the range on that day, we can see that the market hit that on Thursday. But each 3 candles, so the first 3 candles, then the 4th candle, we have a high and a low. The market works back down into that move up in the first hour of the session. 1, 2, 3, 4, then down 1, 2, and then an engulfment to continue the move. So if we had nothing but just the 12 candles to look at by themselves, you can see breakout, pullback, continuation, breakout pullback continuation. Same thing in Asia, breakout pullback continuation that didn't eventuate, but as they came back down in 3 pushes, they still protected that low that was established in Asia before continuing the move back up towards the high of the day and the high of the session. Again, looking at Friday, we can see the market rolled over to hit stops from the close of the U.S. session before pulling back in that last candle of the first hour. So we get a peak formation, the market moves sideways before, so we have our high and our low, and then the market moves sideways before resuming back to test the low of the day. Comes back down to the low of the day in 1 push, 2 pushes, and then a 1, 2, 3, 33 style low of the day, an engulfment in the second candle of that first window of the Europe London 12 candle window. So again, the low of that session, once the market takes off, potentially may now be intact for that entire session. The market moves up higher, 100 pips, before pulling back and then resuming its upward move. Same thing into the U.S. session. The market moves higher in that first hour, 1, 2, 3, 4 bars to the high. The last candle of the first hour, they go up to that in the beginning of the equities hour, but they do not violate that level. They're at double zeros. Again, traders are chasing the bullpen hammer at the high of the day. The market reverses quickly and aggressively, dropping almost 200 pips. Obviously, Monday was a massive day, but tight consolidation in Asia. But again, that first 8 candle window gave us a high and a low before the market broke out and extended the high, again establishing that the low of the session was still intact. They came back down at the beginning of the Europe London 12 candle window, 1, 2, 3, getting traders who may potentially have been long still in that market, getting them at break even or maybe with a loss. Then in the equities hour, taking the market higher. The second candle of the equities hour remains our high for the session. Same with the low of the first hour being our low of the session. So we talk about structure. There's our rectangle. We have a high and a low. The market trades sideways before pushing 3 times and then engulfing, moving sideways and dropping back through the low of the Europe opening. The market, again, just a massive move down, but we still do the same thing. We see the first hour establish a possible low for the session. We have a high of the 12 candle window. The market is up here, but the market in the equities hour now consolidates 2 pins and then a bull pin in the second candle before engulfing and breaking back in the direction of the original trend. The market moves through the low of the opening of the 12 candle window before consolidating in 3 pushes to the low of the day before engulfing at the low of the session. But that market still moved another 100 plus pips down from the entry after the first 2 candles of the equities hour. So they established a low, but that became our target point. Traders enter the market. We get one full expansion of that high and low from the low of the opening hour as well as the high of the equities hour. So again, measured moves. Just a redrawing. No matter how big the move is, we redraw our geometry and then we look for one of those extremes to be tested or violated, or a pin hammer, pin bar, engulfment entry in the direction of the trend. So although we're at the low of the day, a market moving this strongly, we want to be trading with the market in the direction of that move. Second candle, equities hour. Timing is critical in understanding that. Tuesday, we have the market pulling back in 3 pushes from that big move on Monday, consolidating and then giving us a little bullpen hammer in the open. So we have 1 bar down, 3 bars up, and then the market continues to break higher in the equities hour. So now we have our low of the session, low of the day, potentially intact. The market extends the range out before pulling back and then moving up another 100 pips with 1 push, 2 pushes, 3 pushes in the equities hour. Again, we see the 1, 2, 3 down, stop hunt to the high, consolidation, inside bar, and then the slow, gradual fall over. But 2 things to take in: high bull after that equities hour opens. When they break that, now we possibly will have a measured move of that bar, which is almost 35 plus 40 pips, somewhere in that area, 50 pips actually. So we could be targeting a 100 pip move down. And again, although that stop is larger, we can adjust our position sizing, or as some traders have mentioned, they've gone in on shorter time frames. So today we see the first hour now potentially established a low of the session for us as the market moved higher in the equities hour for consolidating and doing a very similar pattern, but then failing to follow through in 3 pushes before coming back and consolidating inside of that upper 25 pip box. So again, just to reinforce, what we're looking at is the importance of understanding the timings. That first 2 hours will often have established the extremes for that session. So again, we look at the pound. Obviously, the pound in Asia sometimes will have some trades, but for the most part, it's a fairly small consolidation. But we see the 1, 2, 3 at the beginning of the 12 candle window to the high of the day, the high of the week, an engulfment in the 3rd candle, and then a 50 pip move down through the low of the day, stop hunting traders who potentially were long off of Friday's low. So we see that move, but also we understand now that we have a high of the session in place. When we get down to our 4th candle of the equities hour, they pull back and then they work it again into pushes before coming back fast and aggressively, 50 pips in 1 candle, and then moving back through the high of the day. So that first hour of the equities hour was in place, but they worked the low. They worked down into the low. Second time, big engulfment, getting traders to chase that move back up. And you can see then again when they come back down, they come inside of that bar so that traders who are long are now caught and trapped, which is why they do it fast and aggressively. Again, yesterday we see a very strong 1, 2, 3 at the beginning of the session with some follow through in a 25 pip box, but we have potentially have our low of the day or the session intact. And then in the equities hour, they follow that through and pull it back into consolidation, establishing the high potentially of the day in the session before they come down in 3 pushes. In the beginning of the next 12 candle window, they come down, establish a low before pulling back on the very first candle of the equities hour. So that first 2 hour window will often give us a higher or low for the session, potentially maybe even for the day. But again, if they go down and they get a big, strong momentum candle, traders are afraid to take this. But when you understand the rationale why, because the perception is it's too big or that my stop's going to be too big, but understand the psychology behind a market move like that. All this volume is now trapped, and if they come back inside, they allow these traders who potentially are sitting on losses to get out of the market. So that begs the understanding that they may not come back and they may just continue to move away because they don't want to allow this trap volume to be able to get out at break even or with a smaller loss or anything else. And in this case, they're moving further away, and that can margin or make their losses even bigger. So again, that first 8 candles, high and low of the session, high and low of the day, they could go 1, 2, 3. That may be the extreme for the day, but in that first 8 candles, we will most likely have our high and our low for that session in place. So hopefully you got some value from today's video, traders. Keep it simple. Keep getting better. Stay disciplined. Stay focused. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.